Afternoon, everyone. We're going to be starting the conversation this afternoon very soon. Thanks everyone for joining us. I want to introduce myself. I am the Organization and Professional Development Assistant within the Organizational Development team here as part of the HR office. It is my pleasure to welcome you to our presentation this afternoon as part of Spring into Wellness Virtual Employee Wellness Fair. So thanks everyone for being here. We've had some really great sessions thus far today. I'm not sure if anybody was also able to join the yoga during the lunch hour from 12 to 12:45. That's hosted on a regular basis on Mondays and Wednesdays. So we're very fortunate to be able to promote that as part of our wellness activities. I first want to take a moment to acknowledge the place that brings us together today, and wherever we may be joining in from today virtually. I wanted to state that Mohawk College is located on the traditional territory of the Haudenosaunee and Anishinaabe nations. It is within the lands protected by the Dish with One Spoon Wampum Agreement, and it is home to many Indigenous peoples from across Turtle Island. I myself am a settler. At this time, I would like to introduce our speaker, Mutaz Dirar. Mutaz is a financial advisor based in Waterdown at Edward Jones. He's also my financial advisor, and he brings experience in education. And with this, he has built a successful investment practice by collaboratively working with clients to create actionable plans that utilize sound investment advice and guidance. Mutaz is a member of the Rotary Club of Waterdown and resides in Ancaster with his wife and 3 daughters. Should you have any questions during the presentation, we encourage you to relay your questions to Mutaz through the chat, and we will be addressing those at the end of the session. Please join me now in welcoming Mutaz to present the rules of the road for investing. On to you, Mutaz.
Thank you very much. Hello, everyone. My name is Mutaz, and I'm a financial advisor with Edward Jones Investments. I'm very happy to be here with you today, and I thank you for committing the time to learn more about finances. I would quote Warren Buffett in this one. He said, the more you learn, the more you would earn. So hopefully whatever you're gonna learn today, you'll be able to apply it in your financial situation and earn some more money with it. So the seminar today is about the rules of the road. So it's about 10 rules that have been tested over time, and they showed success for achieving financial freedom. I like to call them the 10 commandments of financial freedom, because I believe if you follow them, you'll get to the promised land, which is financial freedom. So I'm going to share them with you quickly. Like I think I'm aiming for half an hour to 40 minutes to go through the slides, and then focus more on your questions, because I think they will pertain more to your personal situation, or they'll be more personalized, basically. So let's dive in for the first rule in our slides here today. So the first rule is develop your strategy. What's the most important goals to you, and how you're going to document it. So basically, when we talk about developing a strategy, normally we sit down with the client and ask them questions about their goals and their current situation. The strategy will be different from someone to another, because everyone has a different goal. So based on their financial goals, we'll develop their strategy to achieve that goal. We'll bear in mind, for example, time horizon. That's a very important factor. How much time they have before achieving that goal, whether it's retirement or whether it's saving for a kid education, college fund, or any of these things. So how much time we have before we get to that goal, and then also how much, like what's going on with their financial picture today, like how much they already saved towards that goal today. And also we take a look at their risk tolerance as well. How much are they comfortable with taking risk? When I say risk, I mean fluctuation, like up and down with the investments and with the markets. So documenting these goals is very important, because if there's no goal, it's very hard to achieve anything. But once you have a destination, then once you set your campus towards that destination, like will help you to get to it over time. The second slide here talks about understanding risk. So risk, as I mentioned earlier, it has different meanings for different people. So earlier I mentioned fluctuation. Fluctuation basically is up and down. So the market is up last year, for example, let's say 20%, is down this year by 15%. How comfortable are you with this fluctuation with the market? And then also, time horizon plays an important role in the risk as well. How much the person has in terms of time before getting to that goal. If the person, for example, wants to retire in 5 years, then the risk tolerance will be different from someone who's planning to retire in 20 years or 15 years. They will have more tolerance for fluctuation, or they should have more tolerance for fluctuation than the person who has a shorter time horizon. And then also with the risk, we like there's different levers for managing risk. So besides, like, investing for the long term, like having a longer time horizon is a very important part for managing risk. Investing in quality investments, meaning companies that have been around for a long time, staying away from like penny stocks and the likes, diversifying. There's more slides that's gonna speak to risk. We're gonna dive into them one by one in the next slides. But I just wanted to mention that risk will go beyond this slide again, because it's a very important factor for investing. And actually, I would quote here a saying by Benjamin Graham. Benjamin Graham is Warren Buffett's professor and teacher. He taught him about investing. So he said that when you invest into a company, or when you're buying a share of a company or stock of a company, he said that the first goal for you should be safety of principal. So this speaks to risk. Like, risk is very important. Like, we are managing the risk part is the most important thing of the investment endeavor. So he said, number one, you invest in a company that will give you safety of principal. And then number two, adequate return. So return actually comes after the safety of your principal. So, yeah, we're going to discuss more other aspects of risk. But the first one here, as we said, we want to make sure that we are comfortable with the ups and downs, and that we have enough time horizon before the goal. The slide here speaks about diversifying your investments. So that also speaks to risk as well. As we all know, that saying that says, do not put all the eggs in one basket. So we want to make sure that the money is diversified between different investments. These investments, they don't have to be in the same asset class. When I say asset class, there is different asset classes in the investment world. For example, you have real estate. This is deemed as an asset class. Then you have, for example, the stock market. So shares in, like, for example, companies like TD Bank, or Johnson & Johnson or Pfizer or whatever. These are called stocks. So this is a different asset class. We have, for example, fixed income, which has like bonds and GICs. Anything that has GICs stand for guaranteed investment certificates. So anything that has a guarantee factor to it, these are called fixed income. So they fall under one class. You have, for example, private equity. That's another class. Private equity is basically like stocks, but they're not publicly traded. They're not available to everyday investors. So this is also a different class. So there's different classes for investments. And normally you want to diversify between all these classes, because these classes, they relate to each other differently. For example, when you invest in the stock market, there is almost like a zero to a negative correlation with the bond market, with the fixed income market. Meaning, if stocks go up, normally bonds to stay the same, or maybe go down a little bit, and vice versa. If stocks go down, then bonds tend to stay the same or go up. So you wanna, when you diversify between different asset classes, then you're making sure that not all your portfolio is down at one time, and then it's all up in one time. You want to have like different asset classes where you have different performances within a set period of time. And then beyond asset classes, like, you want to diversify geographically. So for example, Canada only comprises 5% of the total world stock market. So you don't want to have most of your money in Canada. You want to be diversified outside of Canada. Most of your money should be outside of Canada, just from a point of diversification and how much we are compared to the whole world stock market, 5% versus the rest of the world. So diversifying geographically, diversifying between different asset classes, diversifying within the same asset classes. So for example, when you look at an asset class like stocks, for example, you want to have, we don't invest more than 5% of your money in one company. So not more than 5% of the money in one stock, no matter how good that company is, just in case of that company, something happens to it that we haven't foreseen, then if you lose that money, you will make it elsewhere within your other investments. So, and then also there's diversification between different sectors. So for example, in the stock market, there's 10 different sectors. So there's the financial sector that will encompasses companies like TD Bank, like RBC, like Manulife. Then there's also the industrial sector, companies like, Union Pacific, Canadian Pacific Railroad, Honeywell. These are all industrial companies. You have healthcare, so that's the companies like Pfizer, Merck, Johnson & Johnson, etc. So there's 10 sectors in the stock market. So you want to also be diversified between all these sectors because all of them, they don't move in the same direction. There is no like a perfect correlation between them, which is good. So the more you diversify, the more you reduce your risk. So in the next slide here, this one here talks about quality. So as we mentioned earlier about risk, we said there's different factors that we look at different levers for managing risk. So quality is one of them. So what is quality? Quality meaning like, investing in companies that has been, the first thing I would say, they've been around for a long time. Companies that have stood the test of time. So when they've been around for a long time, that means they've seen adverse market conditions and they emerge successful from them because if they're still around, that means they've done well during this during these difficult markets, and they emerge successful from them. And you want that speaks to their quality. So companies that have been around for a long time, they have a solid track record over time. They have a quality management. So they're well managed. They have good leadership. They have a vision for the company, and they have executed well on that vision. Also, the company would have a moat around it, meaning like this company have a competitive advantage. So that makes it difficult for other competitors to get into that field. So for example, a company like Coca-Cola or Pepsi-Cola, these two companies, they are like, almost they have a duopoly on these soft drinks realm. Like the same thing with the Visa and MasterCard. They almost have a duopoly on this payment field. So you wanna, so companies like those make it difficult for other competitors to get into that field. So they have a moat around them, and that moat is good for you as an investor. So that speaks to the quality as well. Also, quality of earnings. We want to make sure that those companies, they have very good earnings. They have, when I say earnings, I mean profits. So they have very good profits. And ideally, we want to see these profits being increased over time. So they're coming up with new, obviously, like the company ideally will have, will invest a lot of their revenue in R&D, research and development, and through this research and development, they're coming up with new products that will generate them more profits, and this and these profits, they're going to translate to you as an investor through the appreciation of the value of your shares in this company. So so we spoke to quality, spoke to the quality part, fads versus fundamentals. So this is very important. This speaks to investor psychology. So you don't want to be following like the tips from friends and from like, your like, I don't know, like, the taxi driver, or like, your hairdresser or whatever. Like, once you start getting ideas from anyone about a certain investment, then you should know this investment is probably like a bubble. Like, we've seen it over and over again. We've seen it in the tech bubble. Like everybody was talking about the tech sector during that time. And then soon after, like, it burst, the bubble burst, and people lost a lot of money in the tech sector. We've seen it recently with the marijuana bubble. So a few years ago, if you recall, everybody was talking about the marijuana sector and that the government was going to legalize it, and everybody was investing in it. And then soon after, the bubble burst, and nobody talks about it anymore. Now people are talking about crypto. So I think also it's just a matter of time before this bubble bursts again. So when you invest, you want to stay away from fads, like, whatever people are talking about, like, that's just noise. You want to stick to fundamentals again, like, sticking with the quality businesses, finding businesses that you believe in their products and they have quality earnings, quality management, and then investing in them and hanging on to these investments for the long term. Do not reach for yield. This is basically speaks to dividends for stocks. So stocks normally they pay a dividend. This dividend is a portion of their profits they give back to the shareholders. So for example, a company like TD would pay maybe around 3% a year in dividends to their shareholders. So these dividends, basically, they are paid to you in cash. And then you can do whatever you want to do with them. You can spend them, or you can put them back into the company, buying more shares with them. So when you see dividends for these corporations, don't let it like hijack the whole discussion about the merits of the investment. The dividend is just a small part of the investment thesis, but not like all of it. So when you invest in a company, like, don't just look at the dividend part and say, for example, this company is paying 7% dividend, so therefore it's a great company. No, dividend is just a very small part of the investment thesis. So just keep that in mind. Do not reach out for yield for dividends of stocks, or even for bonds as well. So here we speak, the slide talks about investing for the long term. So this is very important to have a long-term horizon. The long-term horizon helps you focus on the big picture, focus on the ultimate goal, getting to the financial freedom, whether it's retirement or whatever it is. Maybe also, like, maybe, as I said earlier, college education for the kids or anything like that. So when you invest for the long term, that helps you to keep focusing on that goal, because on the day-to-day market events, people can get distracted by what the Fed's going to do. Are they going to raise the interest rates or not? What's going to happen in the labor market? Is there shortages? Is there going to be like layoffs? Is there going to be supply chain shortages? What's going on with the dollar? Like, is it gonna decrease, or what's going on with oil? Like, all these events, these things, they can distract people. And when you invest for the long term, you'll be able to focus better on the price rather than the day-to-day events that always happen in the market. So this time in the market, not timing the market, I believe Warren Buffett said that. He said if you spend time in the market will reward you. But if you try to time the market, then that's when you're going to start getting into losses, because it doesn't work. Like, anyone who tells you they can time the market, they are not telling you the truth, because no one can do that. No one has a crystal ball to know exactly when to get out and when to get in from the markets. This has been tried like over the past 200 years, and nobody was able to do it. Even Buffett himself, who is deemed like the greatest investor of all times, he himself said, time in the market rather than timing the market. Like, stay in the market, you will be rewarded. Do not try to time the market, because it's futile. There's no point of it. And then buy and hold doesn't mean buy and forget. So obviously, like, when we invest into like these shares of companies, we don't just buy them and forget about them. We, as financial advisors, we continue to maintain monitoring these companies, making sure that their financial statements are solid, making sure that the management is delivering on their promises for the shareholders, making sure that the companies still have a moat around them. So the groundwork continues to happen as long as we have invested into these companies. Have a realistic expectations. So this is very important to set expectations from the beginning. So the expectations for the markets, they've been anywhere between 3% up to 11%, depending on how much the person is allocated between stocks and bonds. These are the two main asset classes. So the more you have money in the stocks, the higher the return, but also the higher the fluctuation, the higher the up and down. And the more you are in bonds, the lower the return, but the lower also the fluctuation. So normally for people, we'll have like a mix depending on their risk tolerance. So it could be 50-50 between stocks and bonds. It could be 80-20, 80% in stocks or 20% in bonds, or vice versa, depending on the person risk tolerance and then their time horizon. So so we said anything between 3 to 11%. 3% will be something like, for a bond portfolio, like, they've been averaging between 3 to 4%. 11%, that's like the average performance for the stock market, the S&P 500. That's like the broad measure of the stock market in the US. So that one has averaged around 11% over the past almost 100 years. So this is the expected range for the investment performance. Anything beyond that, like, I think that will be like just stretching it. Like, if somebody tells you, like, we're going to get you 20% or 25% or something like that, that's probably not the case. I don't think it will be true. Warren Buffett, as we said earlier, like, he's the greatest investor of all times. His track record is around 22% per year. So this is the greatest investor of all times, and he has done 22% per year. So yeah, anything above 11%, I think will be very hard to achieve. So this is the expectations. So 11% when you use the rule of 72, the rule of 72 says 72 divided by your average return, it gives you in how long your money will double. So if we say 72 divided by 11%, which is, we said this is the S&P, like the market performance over the past 100 years, 11%. So 72 divided by 11, that gives us 6.5. So that means 6.5 years. Every 6.5 years, the money will double. So if somebody had $100,000 today, in 6 years it will be 200,000. And another 6 years, 400,000. And another 6 years, 800,000, and so forth. So every 6 years, their money will double if they continue to achieve the same rate of return on 11%. Okay, so here we have maintain your balance. So maintaining your balance meaning maintaining your asset allocation. Earlier we spoke about asset allocation. We said there is different asset classes that people can invest in. We mentioned real estate. We mentioned the stock market. We mentioned the fixed income market, which has the bonds and the GICs. We mentioned maybe crypto, private equity. These are all different asset classes. So you want to maintain your balance between them. Like investors right now, mainly they invest between stocks and fixed income, stocks and bonds, basically. So when you start investing, let's say you are a person who's 5 years away from retirement. So let's say your portfolio is 70-30, 70% in stocks, 30% in fixed income. So you want to make sure that over the years, you want to maintain the same balance, because over the years, the portfolio will change because of stocks. They're going to continue to grow faster than bonds. So your stock allocation will increase. So from 70%, it might become 80%. So we want to keep an eye on that. So once it gets to 80%, now we have like a different risk profile now, because your stock allocation is way higher than what it used to. So now we want to bring it down to the original allocation. So we'll trim it. We'll sell that 10% of the gains of the stocks and then buy bonds with them. So bring it back to the 70-30 allocation, the original allocation. So so maintain the balance. That will help reduce the risk in the portfolio. So another major another lever for risk, maintaining the balance of the portfolio. So now we're going to go to the next slide. Slide number 8, prepare for the unexpected. This one is very important. This one speaks to state planning. So once we build the financial plan for the investor, meaning we ask them questions as I said earlier about their goals and their aspirations and their current situation, how much they saved already, and how much their investments are doing in terms of performance, like in their what kind of return are they getting? Are they getting 5% or 8% or 10%? So after we do all these things, and then after we come up with the written financial plan, about the first slide, if you guys recall, the first slide about developing the strategy and documenting it. So making sure that we wrote down the steps to achieve that goal. So we finish all that work. Now we want to stress test the plan, the written plan that we developed. We want to stress test it. So meaning, we'll say, worst case scenario, let's say you have 20 years for before you retire, and we already said that we already set up how much you need to save per month, and the required return and all this stuff, all these things have been completed. So now we want to stress test the plan, the financial plan. So we'll say, let's say you have 20 years before retirement. Let's say tomorrow you run into an accident and then you pass away. So normally we start with the most catastrophic event, which is loss of life. So in that case, what's going to happen to your loved ones? If there's a surviving spouse, if there's children, what's going to happen to them in that case? And then based on that scenario, we'll start building some solutions. And then we'll go to the next most catastrophic event, which is loss of ability to work, loss of income. So in that case, if the person get into an accident and they have a disability, they're not able to work anymore, what's going to happen in that case? What's going to happen to the retirement plan? Because we have still 20 years of contribution to RRSPs and tax-frees and all this stuff. And if you're not working, you're not able to do these contributions. So what's going to happen in that case? So we just prepare for the unexpected, by making hypothetical situations about worst case scenarios, and then preparing for them, and making sure that if anything happens, that thing is not going to derail our plan, our original plan. Also, very important part of the preparing for the unexpected is to have a will and power of attorney ready. So we always mention this to our clients, whenever there's a review, we just want to make sure that the will has been updated in the past 5 years or so, the will and power of attorney. And if there is no will or power of attorney, then we'll refer them to some lawyers that we work with, so they can interview them and see which one they like to work with, and to develop the will and power of attorney. But these things are very important because the cost of not having them is very significant. About a year ago, I had a client who passed away, and they didn't have a will, and they were living outside of Canada at the time. And it was to go through the state, it took actually 2 years to settle it, 2 years to settle the state. And in the process, it cost them around $90,000. So $90,000 cost and 2 years of time for something that could have been avoided by just paying $700 and getting the will done, and that's it. So definitely, it's the investing the time initially and the money to complete these important documents is very important for the well-being of the family in case of something unforeseeable happens. So in this slide here, we're gonna talk about focusing on what you can control. So this is very important. Again, about focus, having a laser focus on goals and on what we can control. So we cannot control what the Fed's going to do. We cannot control the markets. The markets, they do their own thing. They're up and down over the short period of time. But over the long term, they've proven to produce results and produce like positive returns for their investors, for the investors in the market. So we just need to focus on what we can control, which is like buying quality investments, staying the course when the market is down, and buying more, ideally, if possible, when the market is down. Because we all heard about buy low, sell high. Buy low, sell high. Everybody knows about this old business adage. But in practice, very few people practice it. Most people actually do the opposite. Whenever the market goes down, they want to get out. And then when the market goes up, they want to buy. Like I remember one time, the market was going like, it was getting like to a peak high. And then I got this call from one of our investors. And he told me like, I want to invest very quickly in the market. And I said to him like, why very quickly? It's to me before it goes down. It's to me exactly. So, already went up over the past few months, very, very high. So, it's going to come down and you want to invest in it quickly before it goes down. So that it doesn't make sense, right? And he said when he heard himself, then it dawned on him that it didn't make sense to invest in the market when everything is really very high and you want to invest in it quickly before it goes down, because it doesn't make sense. When it goes up very, very high, then what's coming next is big down. And whenever it goes down, the next thing that's going to come is going up. So the best times to invest in times like those when the market is down, because we know the next thing that's going to happen is just going to be up. Nothing stays forever. Down doesn't stay forever, and up doesn't stay forever either. So focus on what you can control. Time-tested principles. So these 10 rules that we shared today, the 10 commandments, these are all time-tested principles. They proved their efficacy. They are not predictions, not speculation. And then do not let emotions drive your decisions, because, and that's actually a big part of our work as financial advisors. I would say almost 30% of our job is behavioral finance or behavioral coaching, meaning when the market is down, if the investor wants to sell, like we talk them out of it. Don't sell. You have quality companies, you have Apple, you have Microsoft. Do you think these companies, they're going to go bankrupt this year or next year? No. So then there's no point of selling. Just hang on to them or buy more of them. Or the other way around, somebody wants to invest quickly, before the market goes down. This is not the time to invest more. This is the time to either rebalance, meaning sell some of the gains, gains that you made already and have them in cash or buy bonds with them, or stay the course, but this is not the time to buy more. So then let emotions drive the decisions. And talking about emotions, that brings me actually to a very interesting story. So the story actually talks about different things. One of them is emotions, and then also one of them is that investing is not purely science, and also is not purely art either. It's a mix between art and science. So the story talks about actually Isaac Newton. Isaac Newton, the man who created calculus, and the man who discovered gravity. So he basically, during his time, he invested in a company called South Sea. So it was a publicly traded company, and he invested into their shares, and he made a lot of money from that company, a lot of money. So he did the right thing, and he sold the stocks because he made a lot of money from it, and he got out of the company. And then a few months later, he looked at the stock, and the stock was still going up strong. So he decided to go back again, and this time he put more money into it. He put $2 million worth of today's money, $2 million of today's money into that company, South Sea. And then what happened after that? South Sea went down if you just Google South Sea, you'll see the graph. It's horrific. The stock went up like this, and then it went down 90 degrees basically. It went down straight to zero. So he lost all the money, the $2 million, all of it, the money he made before and the additional money he put in, all the money he put into South Sea, he lost it. And they said that till the last day of his life, he forbade people from saying South Sea in his presence. So that talks to several things here, number one, not letting emotions drive your decisions, because in this case here, like, he let greed dictate his the step. So he made the step because out of greed, he made so much money of it. The stock was still going up. So he said, you know what? I'm going to put more money into it, and I'm going to make a killing on this company. And then he ended up with zero, losing $2 million in one company. Number one. Number two, it's not rocket science, because I mean, Isaac Newton is one of the smartest people who in human history, and he still made a huge mistake with this company. So that's the moral of the story for this story about Isaac Newton and South Sea. And then the last thing here, focus on your strategy. So, like, it doesn't matter what your friends tell you. Like, everyone, as we said earlier, they have a different goal and they have a different strategy to achieve that goal. So we want to make sure that you focus on your own strategy, focus your own goals, and the rest is just noise. Step number 10 here, review your goals and your strategy regularly, making sure that you stay on course, making sure that we are achieving the things that we said we're going to achieve during the setting up the financial plan, making sure that we are achieving the milestones in that financial plan. And then also, this financial plan is a living and breathing document. So we're making sure that we are updating the plan with the new events in your life, because like we all have dynamic lives. Nothing stays static. So we want to make sure that whatever changes in our life, we want to make sure that change is reflected in our financial plan. And then continue doing these periodic checkups, because we want to make sure that the things that have been set up in the plan, that are being achieved. And if there's anything that needs to be changed or anything that needs to be addressed, then it will be addressed during these regular reviews. So we suggest, like, at least once a year to, I mean, depending on the person's financial situation, but at least once a year, like a checkup, a financial checkup is very, very important, just to see where they are financially and what's happening with their goals. Are they going to achieve it or not? And if they're not going to achieve it, then what they can do to be able to achieve these goals. So here's the summary for the webinar. So we're going to go through the rules quickly. So rule number 1, developing your strategy, or having your financial plan written, having it documented. Number 2, understanding risk, making sure that you define what's risk for you. We said some people, for them, risk is loss of principal. For some people, risk is fluctuation. So what's risk to you? How comfortable are you with the market fluctuations? The stock market, for example, in some years lost 40%, 50% of its value. Are you okay with that? What are you going to do if you were during that market downturn? What are you going to do? Are you going to sell, or are you going to stay the course, or are you going to buy more? Like discussing the risk is very, very important. And also making sure that you are investing into quality companies that are not going to subject you to high risk. When I say that quality companies, I mean, like, staying away from penny stocks or any companies that don't have quality earnings or profits. Rule number 3, diversify for a solid foundation. So meaning, don't put all the eggs in one basket. Diversify between stocks, so not more than 5% in one company, in one stock. And then same thing for bonds. Diversify between the different asset classes, stocks, bonds, real estate, crypto, private equity, like all these different sectors, different classes. Rule number 4, stick with quality companies, quality management, quality earnings. Rule number 5, invest for the long term. Keep an eye always on the price. Think about, like, your goals after 10 years, 20 years, whenever that financial event that you're saving for. Keep an eye on that, not on the day-to-day events, because there's always going to be events in the market, and these events are all noise. Rule number 6, have a realistic expectations. As you said earlier, like, you should have a realistic expectations with respect to the market's performance, and also to your risk tolerance as well. If you are a person with very low risk return, you cannot expect to have a high return on your investment. If somebody is investing all their money into bonds and GICs, they cannot expect 8% return on their money. It just doesn't happen. And so have realistic expectations. And then rule number 7, maintain your balance, meaning whenever an asset class go beyond its original allocation, bring it back to the original allocation. So we give an example of if somebody has 70% in stocks and 30% in bonds, and then after a few years, because stocks have grown and became 80% now of the total value of the portfolio, they need to bring it down, sell this 10% and invest it into bonds and bring it down into the original allocation. The same thing you can apply to the individual companies. If you have invested 5% of your money, let's say in Apple, and then Apple doubled in 1 year, so or 2 years or whatever, and became 10% of your portfolio, then make sure that you trim that 5%, you take 5% gain and invest it elsewhere, and then put the 5% and leave the original 5% that you invested into Apple or whatever the company that you invested in. So maintain your balance, because that reduces your risk. Rule number 8, prepare for the unexpected. We said, like, that's estate planning, life insurance, disability insurance. Make sure you have enough of these ones. Make sure that you have a power of attorney and a will in place. And if you have ones already, make sure they're updated every 5 years or so, or whenever there's like a major event in your life. Rule number 9, focus on what you can control. Again, like, you can control buying quality investments. You can control staying in the market and spending time in the market rather than timing the market. You can control buying more when the market is down, but you cannot control what the Fed's going to do. You cannot control the dollar or the oil prices, or, like, unemployment. All these things you cannot control them, so just don't worry about them. Rule number 10, review your strategy regularly. And then here, this team approach slide is very important. When the client is working with the financial advisor, so we'll say here's the financial advisor, and then here's the client. Here is their lawyer and accountants and other professionals that they work with. This is like in our case in Edward Jones, like that's my assistant Robin, and that's me here. Here's the client, and here's our Edward Jones back office support. This will apply to clients differently with different financial institutions, but the idea is the same. The client in the middle, their financial advisor, their legal and tax professionals and other professionals, and then the support of the financial firm that they're investing with. But what I'm trying to say here is that there's a quote by Robert Kiyosaki. Robert Kiyosaki, the author of Rich Dad, Poor Dad. So he said building wealth is a team sport, and it is very true. So when you're building wealth over time, you want to build your team. You want to start building your team. So your team starts with your financial advisor and your accountant and your lawyer, and then from there you start, like, expanding more, like, your mortgage broker, your real estate agent, and so forth. So always you want to work with the team, because normally this team will have, like, your best interest at heart, and then also they can work in synergy together. Meaning, like, for example, with my clients, sometimes the accountant will come to my office for some of the reviews, or vice versa. Like, I would go to the accountant office and meet with them there. Sometimes the lawyer would come to my office and review with my clients their situation, or vice versa. So anyway, like, it's what I'm trying to say here is that building wealth is a team sport. So if you have a team, a good team in place, that's great. If you don't have a team yet, then start building one, and you build them over time. So with that, I think I conclude the webinar. I will return it to you, Heather.
Thank you so much, Mutaz, for the presentation today.
My
As
pleasure.
many of you can probably relate, financial wellness for me is something that can impact my stress and my sleep and all of those things. So there has to be a connection between financial wellness and overall wellness in my life. So I'm glad that so many people were able to join us today with you, Mutaz. Thank you.
My pleasure.
And as we saw, today is merely an introduction to investing, but each time I speak with Mutaz, I learn more about investing. And I can assure you that no question is a stupid question because I've probably already asked it of him. But I'm curious to know if from our participants today, by way of placing a number in the chat, 1 through 10, is there a rule today, participants, that stood out to you? One particular rule from 1 to 10 that stood out. I'd really love to hear in the chat 1 through 10 of the rules that stood out to you. We do have a few questions that we're going to head into now. We've had a few questions come up. So Usha asked, are ETFs a good way to get some diversification?
Yes, yes. The ETFs are basically, they stand for exchange traded funds. So exchange traded funds are a basket of investments. They could be baskets of stocks or a basket of bonds or a mix between both of them. Normally these baskets, they vary in terms of how much each basket will have in investments. So some of them will have hundreds of investments, some of them they will have tens of investments, some of them will have thousands of investments. So depending on the ETF, but yes, they are a very good way to diversify because most of them, they will have more than 10 different investments within the ETF, and that's proper diversification.
Great, thank you. Also, we are still taking questions in the chat, and again, please feel free to enter your rule number that you feel stood out for you. Wafa also asked, for the first-time investor, where do you start other than GICs, bonds, and so on that are considered safe investments? What are your thoughts on mutual funds?
It's a great question. So, so for the first-time investor, I would assume in this case they're still like they still have a long-time horizon before they retire. So in that case, if that's the case, if they have a long-time horizon before they retire, then they should invest in growth because they have a lot of time. So growth meaning like something that will grow in value over time. You will have like higher amount of fluctuation, but again, like because you have a long time horizon, fluctuation doesn't really matter anyway because you're going to be in it for the long term. What your main goal here now is to grow your money, not to reduce the fluctuation. So if all these assumptions are right, then mutual funds will be a good place to invest in. I wouldn't say GICs. GICs right now, they're paying 1 or 2%. If somebody is just starting investing, they want to grow their money, not just keep it at 1 or 2%. 1 or 2%, that means if we use the rule of 72, 72 divided by your average return, it will give you in how long your money will double. 72 divided by 1%, that's going to 72 years, the money you're going to double in 72 years. So that's very, very long time. So that's why I would say, like, GICs are not really an ideal place, especially in this current environment with inflation at almost 7%. So if your GIC is giving you 2% and your inflation is 7%, you're actually losing 5% guaranteed, 5% loss. So so for somebody who's just starting out, I would say, like, mutual funds or ETFs will be a very good place to start with. And then also building your knowledge. Like, building your knowledge is very important, and it's a very good place to do that with your financial advisor. I always tell my clients, think of me as your financial coach. Always ask me questions, and I will always also challenge you. I'll always throw things at you, things that you're not comfortable with, and I'm gonna throw them your way and just try to challenge you and have you like build your financial muscle. So yes, like, mutual funds or ETFs, and then also building your knowledge over time is very, very important because your financial advisor can invest with you with as much as you know. So the more you know about your investments, the more he can offer you different investments that might give you a higher return.
Great questions. Wafa also asks, what is the minimum investment required to have a financial advisor?
That's a good question too. So depending on the company, every company is different. So with Edward Jones, the company is mandating a minimum of 100,000 lump sum. Some other companies, they have different minimums. If the person has lower than 100,000, a good place to start with is their bank, because like normally the person has already their bank account with them and they have a relationship already with them. Then in that case, they will say, yeah, we can open a mutual fund account for you, and then you can invest into like some of their mutual funds. So if that's the case, then just ask them for like a growth fund. Just tell them about your goal that you want to grow your money, because you still have a long time before you retire or before your financial goal. So you want something that is growth, and then see what's the average return for that fund. And ideally, that fund has been around for 10 years or more in terms of time horizon, because as we said earlier, like we want to see a track record that speaks to the quality of the investment, the track record. The longer it's been around, the longer it's been around and it has a good track record, the better quality the investment is. So you want to ask these questions like, quality mutual funds. You want to ask about the track record. Has it been around for 10 years or more? What's their average performance? You want it to be averaging something between 6 to 10% or 11%. That's the average you want to be looking for a growth investment. I mean, past performance does not guarantee future performance, but at least in the past performance, you want to see these numbers.
That's so helpful. Thanks so much, Mutaz. And just one more question from the chat. We've got, what's your suggestion between RRSP and TFSA allocations in terms of percentages? Keeping in mind that many of us have a defined benefit pension, and does that affect the suggestion?
That's a great question. So the allocation between RRSP and tax-free savings accounts, that one would be definitely normally based on your tax rate. So if you are in a higher tax bracket, then you want to be contributing more to RRSPs because it's going to reduce your taxes. You're going to get a refund. The refund, you can put it back again into the RRSP, or you can put it in the tax-free savings account. So you're reducing your taxes, and then also you're increasing your contribution to either RRSPs or TFSAs. So if you're in a higher tax bracket, then RRSP will make more sense. If the person in a lower tax bracket, then tax-free savings accounts will make more sense. If their tax bracket right now is the same tax bracket they're gonna have when they retire, then tax-free savings accounts will make a better sense. So the short answer to that question, tax-free versus RRSP allocation, depending on your tax bracket, the higher your tax bracket, the RRSP will make more sense. With respect to the defined benefit, depending on the value of the defined benefit, if the value of it is high, then definitely in that case, you want to contribute to tax-free savings accounts, because the withdrawals from tax-free savings accounts are not taxable, versus the RRSP are taxable, so they're going to be added to your income for that year. So they're going to add your defined benefit and your RRSP benefit together.
Great. Thanks so much, Mutaz. And thanks to everyone for the questions and participating in today's session. If you have any additional questions, please send them to professionaldevelopment@mohawkcollege.ca, and we'll see that Mutaz gets them and responds to them. We're just so excited that this wraps up our first day of our wellness fair here at Mohawk College. Thanks everyone for joining us this afternoon. We hope you did enjoy this presentation. It seems as though the comments in the chat speak to that quite a bit. And keeping in mind that soon you'll receive a notification by email of the evaluation for the session, we hope that you will consider sharing your feedback, as it helps us to improve not just sessions for the wellness fair, but future sessions as well. Thanks everyone, and I hope you have a great day.
Thank you.